Welcome to Dorsey and Whitney's webinar on Annual Forum on Retirement Plan Benefits. I'd like to introduce Tim Goodman, a partner in Dorsey's Benefits and Compensation Group. Tim?
Thank you, Sean. Good morning, everyone, and welcome to the Annual Forum on Retirement Plan Benefits. Today we are going to be having 3 sessions over the course of just about the next 2.5 hours here. Our first session will start in just a few minutes, and it'll be an overview of developments with respect to retirement plans. We'll then take a brief break at just after 10, and at 10:15 we'll be coming back with 2 half-hour sessions. The first at 10:15, a litigation update. Then at 10:45 we'll be doing a fiduciary update. With respect to the program, on the second slide here, you'll see that we have some directions in terms of things. We have materials that are available from Dorsey. You can go ahead and get a copy of them and download them at the web address there, events@dorsey.com. Once the seminar is done, please do complete the attendance form for CLE or other credit, and that then can be sent to attendance@dorsey.com. Finally, if you have questions during the presentation, we'd love to have those questions. We're using the chat feature to review and answer those questions, so please submit your questions via the chat feature, and then the panelists will go ahead and answer them. During all the sessions, we'll be taking questions during the session, and then we'll also try and reserve a few minutes at the end to answer any questions that have come in during the session. With that, I'm going to go ahead and get us started here on our first panel and program. Retirement plan developments and coronavirus impact on plans. For that panel, there will actually be 3 speakers here today. I'm one of them, and with me is Tim Arends, who is also, along with me, a partner here at Dorsey & Whitney's Benefits and Compensation Group. Both Tim Arends and I work with a variety of employers on retirement plan, executive comp, and other benefit issues. Joining us will be Holly Fistler. Holly is Senior Counsel, Employee Benefits at Thrivent, where she works on a variety of employee benefit plan issues, including qualified and non-qualified plans, health and welfare benefits, and also fringe benefits. Prior to joining Thrivent, Holly was a senior attorney at Dorsey & Whitney and has many years' experience in benefits and compensation. So with that, I'm going to go ahead and turn it over to slide 4 here and give you just a brief overview. As everyone on this program probably knows, it has been a very busy year in development. At the very end of last year, of course, the SECURE Act was passed with a number of retirement plan changes. We're going to go through those quickly because on some of those, there have now been some guidance issued by the IRS, and just to provide an overview of those changes again, there's also the Bipartisan American Minors Act, which is a small change, and the CARES Act change, which I'm sure most people are familiar with, which primarily addressed issues in terms of loans and distributions for individuals impacted by the coronavirus. We're then going to go through different regulatory changes and guidance that have been coming out, and finally talk some about how the coronavirus is impacting retirement plans. There's just been a lot of guidance on many of the slides here. We have references to the different pieces of guidance and also websites in some cases so that you can access the guidance yourself. But there's a lot here, so we're going to dive in. And what's going to happen is, Tim Arends, if you're ready, we'll have you start us out with talking about some of the SECURE Act changes.
Great, thanks, Tim. One of the key changes in the SECURE Act changes a longstanding requirement concerning required minimum distributions. Previously, as most are aware, distributions were required to start no later than the April 1st of the calendar year following the attainment of age 70 and a half. And then there was an exception for participants who worked past 70 and a half for severance employment. The SECURE Act essentially bumped that to age 72 for participants and IRA owners who turned age 70 and a half after December 31, 2019. Interestingly enough, you got rid of the April 1 requirement, so it's now really just on a calendar year basis. There isn't that kind of that grace period, if you will, for that first year. It also didn't affect any actuarial increase requirements that apply to defined benefit plans for those who continue working past age 70 and a half. So you want to keep that in mind. One thing to note, though, is that the 50% penalty tax for not taking your minimum distribution is still going to apply, so nothing changed there. Next slide, Jim. Another feature of the Secure Act dealt with post-death distributions. In a number of instances, there was a estate planning technique where, depending on who you named as beneficiary for your IRA or your inherited plan, you could essentially stretch the distribution period over the beneficiary's life. I think, this is my own view, but I think to maybe generate some additional revenue to make the act work, the rule was put in such that there's now a 10-year rule under the Secure Act, where in most cases, beneficiaries must completely withdraw their benefits by the 10th year following the participant or IRA owner's death. There's 5 exceptions listed here. I won't go into all those in detail, but for the most part, the stretch IRA, as it was called, has been reduced down to about 10 years. Tim, I think you're going to take it from here.
Actually, Holly, why don't you go ahead and give the folks a little bit of a description of the different Secure Act changes to safe harbor plans.
Certainly. Thank you, Tim. And as a brief note, just to mention, these are my viewpoints today, and my comments and viewpoints do not necessarily reflect those of Thrivent. So with respect to the Secure Act, they also provided options to plan sponsors to facilitate safe harbor plan administration. One of these options was the increased rate cap for qualified automatic contribution arrangements. So previously, plans with QACAs were required to limit automatic contribution rates to no more than 10% of a participant's compensation. Following the passage of the Secure Act, however, for plan years starting after December 31st, 2019, the Secure Act retains the 10% cap for the participant's first year of participation, but then allows the contribution rate to be escalated up to 15% for years thereafter. This change appears to reflect industry concerns that the 10% cap was too low and didn't really reflect recommended retirement savings levels. One item to note here is that plan sponsors thinking of implementing this change should take a look at their plan documents. If the plan document cross-references code section 401k13 but doesn't really include a specific percentage, such as the 10% cap or a different level, sponsors are going to want to coordinate with vendors and counsel to determine what is the maximum rate that's in effect for 2020 and thereafter, and to determine what kind of plan amendment is necessary. The next slide here on the Secure Act also changed the annual notice requirements for safe harbor plans. So previously, all safe harbor plan designs were required to provide employees with an annual notice. And this annual notice explains the safe harbor contribution formulas, how to make elective contributions, vesting schedules, and so on. This notice, however, this notice requirement has been changed for plan years beginning after December 31st, 2019. Specifically, plan sponsors that have safe harbor plans that only have an ADP safe harbor, meaning the safe harbor design only involves qualified non-elective contributions. For these plans, plan sponsors do not have to provide this annual notice. Now, this does make some sense because when you have a plan with a qualified non-elective contribution, certain levels of elective deferrals are not needed to receive a match. They are receiving the contributions regardless of their elective deferral contribution level. It's important to note, though, if the safe harbor is based on a match, this notice still needs to be required. And the reasoning is that employees, participants need to be made aware of the conditions to receive that full level of contribution. And finally, the Secure Act also facilitates the adoption of a non-elective safe harbor plan design itself. So in the past, in order to implement a safe harbor design, amendments to implement this needed to be adopted prior to the beginning of the plan year in which the safe harbor applied. It was possible, however, to adopt a non-elective safe harbor at a 3% contribution rate during the year, provided that certain conditions were met. With the passage of the Secure Act for plan years starting after December 31st, 2019, plan sponsors have more options for adopting a non-elective safe harbor design. First, they can adopt a non-elective safe harbor design at a 3% contribution rate, provided that the amendment is passed no later than 30 days prior to the end of the plan year to which it applies. And plan sponsors could also choose to adopt a non-elective safe harbor plan design at a 4% contribution rate through the end of the following plan year, provided that individuals are going to receive that 4% contribution rate in both years. So for example, a plan could adopt the safe harbor for 2020 and sign the amendment in 2021, provided that participants in the plan receive the 4% QNEC in both years.
So thank you very much for that, Holly. Tim, do you want to talk about the lifetime income provisions under the Secure Act?
Sure. So this has been, I guess, kicking around in the retirement plan space for quite a while in terms of how do we deal with 401k or defined contribution plans and helping people understand how long or how much they're going to need to retire on, and what that pot of money is going to provide from a monthly benefit if they wanted to, in essence, annuitize that account balance. And so part of the Secure Act was to really impose a lifetime income disclosure on retirement plans where previously none was required. The effective date is 12 months after the issuance of the latest interim final rules and model disclosure or assumptions for conversion factors, and actually we'll talk a little bit later that actually has been issued recently. The lifetime income provisions also have a fiduciary safe harbor. One of the concerns, of course, was if we provided annuities in the plan, or the plan bought an annuity, there'd be a fiduciary duty to select an annuity provider that would be around long enough to pay the benefit. And if under the statute, if the plan fiduciaries go through the proper steps, there will be fiduciary relief for those annuity provider selections. I'm going to flip to the next one, Tim.
Sure.
As I mentioned a moment ago, we've gotten recent guidance that came out on September 18th, last Friday. And for those of you who would like some additional bedtime reading, there's the link to the site. It's 30 pages of triple columned Federal Register material. But it sets forth what's going to be required for the annual disclosure of projected income. It also provides for model language and talks about the liability protection. There's also some special rules for in-plan annuities that would apply. I've not seen those in many plans, but if those apply to you, there is a section in the guidance concerning that as well.
Great. We're on slide 12 now and continuing on with a quick review of the Secure Act. And one of the changes under the Secure Act was a change in the definition of 415 compensation. Previously, there was an exclusion, in essence, for difficulty of care payments. So difficulty of care payments are payments that may be made by an employer or another entity to individuals to assist, say, with foster care. And that amount is normally excluded from income and compensation for retirement plan purposes. The Secure Act actually modified the rules there and provides for an inclusion in compensation for retirement plan purposes, even though it's not included for income purposes with respect to these payments, and made that effective going back to plan years starting after 2015, in essence. With respect to this, the IRS has now given some guidance in a recent notice that was just issued about 10 days ago here, Notice 2020-68, and you'll see that a few times in the presentation in terms of references. Basically, the only thing covered by this are employer-provided difficulty of care payments. So if a person got a difficulty of care payment from another source, such as a governmental agency, that does not count towards the retirement plan for the employer. But if the employer does make such payments, then that can help an employee by having additional compensation, in essence, when considering benefits under the plan. Even the notice says that if the employer does not make such payments, then no plan amendment is necessary. But it might still be helpful as providers, especially vendors, put together the amendments. I'm guessing that they will probably include a provision that says, in essence, not applicable because the employer does not make such payments, just to make it clear to the IRS whether or not the plan actually makes such payments to individuals and address the effective date. In-service distributions to parents on slide 13 here. So this was a change basically again under the Secure Act that allows for specific distributions upon the birth or adoption of a child. Previously, an individual may have qualified for, say, a hardship distribution or other in-service distributions, such as a rollover distribution if they needed money when they had a child and they wanted, if they put rollover money into a plan, they wanted to take it out, they could do that. But now there's a specific reason that allows a plan to provide for these distributions to a parent who's become a parent because of the birth or adoption of a child. The plan may offer a distribution of up to $5,000 within 1 year of the birth or adoption of a child, and it is limited to children generally under the age of 18 or individuals with physical or mental that are mentally incapable of self-support. The limit is on an individual basis, so a married couple could actually get 2 distributions, one each of them for $5,000. And one of the things to note is that the plan offers it, it then also needs to offer a repayment opportunity. Again, Notice 2020-68 provides some more guidance on this, including giving a little bit more detail about some of the things I just noted. For example, if a plan does offer the distribution, it also then has to offer the ability to recontribute the amount to the plan. So for instance, these amounts are not treated as an early distribution. They're not subject to the 10% early distribution penalty. There's no mandatory 20% withholding, although the individual could elect to have elective withholding done on the amount. But the plan, if it offers it, has to offer recontribution. We've received a few questions on this provision, and I know that many employers participate in a number of surveys about how family-friendly their workplace is and assisting parents. So it'll be interesting to see if more plans start to adopt this provision as time goes on. This year with the coronavirus, I think that in part employers may have been too busy to try and address some of the Secure Act changes, but this would be one I would think many employers might actually start to consider taking and adopting, in part just because of response to those workplace surveys. Another change under the Secure Act is with respect to part-time employee eligibility. And this one, the IRS has also given us a little bit of guidance on, but let me give you a quick overview here first. So previously, in general, employees who had not completed 1 year of eligibility service could be excluded from a retirement plan. But under the Secure Act, the Secure Act created two dual eligibility tracks, I guess you could say. The 1 year of eligibility service is still in place, but the Secure Act then added a provision that said, if a part-time person is working and completes at least 500 hours of service in 3 consecutive years, then they have to be allowed to make elective contributions to a retirement plan, a 401k plan. Matching and non-elective are not required for these employees, so they could be excluded for testing for those purposes. But you need to treat the employees who are eligible based on their 500 hours in the 12 months periods being measured starting on and after January 1 of 2021, okay? One of the other provisions in the Secure Act is that this did not apply to collectively bargained plans. So starting next year, this provision will be in force in terms of another way that a person may become eligible for a retirement plan. And if between, say, in the years 2021, 2022, and 2023, someone completes a little over 500 hours of service in each year, they would then in 2024 become eligible where they might not otherwise have been eligible based on never having completed 1,000 hours of service in a year. The guidance, again, in Notice 2020-68 provides us with a little bit of extra information, not very much at this point. One of the things that it does indicate is that vesting, unlike the eligibility determination, which begins in the 2021 plan year, and the IRS recognizes that and confirms that in the notice, the IRS indicates that vesting takes into account all hours worked even before 2021. So for instance, let's say you have a long-term part-time employee or someone who had worked for you and then comes back as a part-time employee or something, you might have a person then who is going to have done service in the past where they have accrued some vesting service. So that's one of the things that I think employers will be looking for more guidance from the IRS on in terms of this provision. Again, someone who, keep in mind there's two eligibility tracks still. If a person, say, works 500 hours for 2 years and 1,000 hours in the third year, they're eligible obviously also based on that 1,000-hour year where they would have completed 1,000 hours. But that also indicates that an employer may have to look further back in terms of determining vesting service for employees. With that, I will turn it back to you, Tim, to talk about pooled employer plans.
Okay, so pooled employer plans. Again, this is something that's been kicking around a little while. Previously, there was an executive order dealing with this, and then after that, the DOL issued some regulations in 2018. But one of the holes in the regulations is it didn't allow financial services firms to sponsor multiple employer plans or MEPs. Thus, what we call the true open MEPs weren't yet permitted. The IRS also, in 2019, issued proposed regulations designed to mitigate what's called the one bad apple rule, which would be where if you have multiple employers participating in a plan and one of the employers had a problem, let's say, with maybe eligibility, they didn't include the right people or something like that. The concern was that error would affect the qualification of the entire multiple employer plan. And that's what the proposed regulations were designed to deal with. Along comes the SECURE Act, which provides a new type of MEP called a pooled employer plan, or PEP. Unlike the traditional multiple employer plans, which could be sponsored by PEOs, trade associations, and that type of thing, the new pooled employer plan, or PEP or PEP, is an open plan, allowing financial services firms like banks and trust companies to sponsor the actual plan itself, and then multiple employers can adopt the plan. The one key element is that employers don't need to have anything in common, which is a change from how things worked previously with multiple employer plans. The PEPs or PEPs are effective for plan years beginning after December 31, 2020, so next year. They can be organized as a 401A plan, so like a 401k plan, or just a simple profit sharing plan, or as a plan of IRA accounts. There are some plan document requirements, such as they must designate the pooled plan provider who is a named fiduciary. The employers remain responsible for monitoring the pooled plan provider and investment assets attributable to the employer employees unless the PPP is delegated fiduciary responsibility under 338 of ERISA.
So Tim, I might just briefly interject. I know that we've had several clients who have been actually approached already by large entities who have told them, hey, we're looking at pooled employer plans and becoming a PPP in essence. And feel free to comment on what I'm about to say here, but I think that one of the, this is both an interesting development and sort of a challenging one. In essence, smaller employers have always had higher costs with respect to retirement plans. So the smaller you are, the less your asset base, the harder it is to say have lower fees in your retirement plan. And as you noted before, there are difficulties with MEPs, multiple employer plans, where if you had one bad apple, all of a sudden your plan was affected too. So generally, we would have discouraged clients from having a MEP in many ways. I think this is interesting because, you know, depending on how all the guidance shakes out, and the devil will be in the details, you know, the idea is maybe this is a way that you could get, say, 100 or 200 or more smaller employers together and create a large volume. And for those small employers, then they have several advantages they might see. They might see, well, although we're a participating employer, we don't have to keep the plan document up. We've gone ahead and we've picked this MEP that's going to be run for us. But here's where I especially appreciate your comments. I think that some of the difficulties that remain to be seen are, you know, how much fiduciary oversight will you have regardless, because it's still your plan, right? And how do you then compare one PPP to another PPP in terms of what's the best deal and what's most appropriate for your participants? And I think there's a whole host of questions like that. It's a nice new option, I guess I'd say, but there's a lot of details to be worked out on this still.
Yeah, no, I think, you know, employers, you know, still are going to remain responsible for monitoring that type of thing and determining whether the PPP or that plan is best for them. And there'll be an analysis they'll have to undertake. Really, I would assume no different than what they do today in selecting vendors and so forth. I think one other advantage would be, you know, you mentioned maybe not having to maintain the plan document, the costs associated with that. But also, I would think that the plan record keeping would be, there'd be some economies there, along with the ability to pool assets to maybe get a better investment options in terms of plan expenses and that type of thing. So potentially some efficiencies to be gained there.
Yes. So there's still the note here about slide 18. I'll let you go over that, Tim.
Yeah, so earlier this month, regulations came out, proposed guidance concerning pool plan providers. So those organizations that are trying to become a PPP to provide this type of plan to multiple employers. The guidance, they set forth the requirements that the providers have to satisfy to register. And for those who are familiar with the non-bank trustee requirements in I think section regulations 1.408N of the code for institutions that aren't banks that want to be a trustee, that they're fairly similar to that. You know, in terms of providing documentation concerning financial wherewithal, experience in the area, and that type of thing. And then the requirements also provide that the PPPs have to supplement their reporting when circumstances change, such as they acquire somebody or a merger or some other situation in their world that would affect their PPP status.
Okay. So on slide 19 here, there are a number of other additional changes under the Secure Act. I should start by saying the Secure Act was probably the broadest piece of pension and retirement plan legislation since the Pension Protection Act back in 2006. We haven't covered everything under it. There's other things that are noted here, such as there's a prohibition on loans through credit cards and similar arrangements that had been previously available and some plans had been utilizing. There's some testing relief for DB plans. There's church plan relief. There's some direction to the IRS about providing guidance on 403B plan terminations and changes in penalties, and even more than that. We've tried to go over the highlights. I guess probably in my mind, in some ways, the two biggest Secure Act changes were the increase in the age for required minimum distribution to age 72, and also the pooled employer plans, which, depending on how developments go there, that could offer an opportunity for a lot of smaller employers, especially, or even mid-sized employers, to join together to try and find more cost-effective ways to offer retirement plans. But those are all things that employers need to be considering. But for the coronavirus, I think there would have been a lot more discussion this year about these Secure Act changes. The IRS has started to issue guidance, as we've discussed. The Notice 2020-68 is one of the first pieces of guidance in some ways about the Secure Act. There's a lot more guidance and regulations that will have to be issued on many of these provisions. But the IRS is also looking for comments from people on these provisions in terms of how to help implement them. Going briefly on to yet another change that had occurred, there was a change made in legislation at the end of last year with respect to the age for in-service distributions for certain plans. So the Bipartisan American Minors Act allowed a change to DB plans, money purchase plans, and governmental 457B plans to allow for an age 59 and a half in-service distribution option if the employer so decided to amend its plan that way. Again, Notice 2020-68 actually provides some guidance on this and confirms that this is an optional provision. Employers do not have to offer this. They can, but do not have to offer this. And the notice also provides a little commentary in particular about governmental plans and what is a normal retirement age. So that's yet one more change for employers to consider if they especially have these types of plans. In terms of other changes, then we go on to our next big piece of legislation, which was the CARES Act. Of course, responding to the coronavirus, Congress passed the CARES Act here in March, and that provided some immediate relief to participants who were affected by the coronavirus. Holly, would you like to go ahead and start in here on slide 21 talking about the CARES Act? Holly?
Thank you. Sorry about that. When the CARES Act was enacted in March of 2020, this legislation included some very helpful provisions that permit participants who have been affected by the coronavirus to be able to access their retirement funds. Now, although these provisions are not required changes, the coronavirus-related distributions and loan rules can be a welcome source of financial relief during these challenging times. So first, in order for participants to be able to take advantage of these distributions and loan options, they need to be able to have been affected by the coronavirus in certain ways. And so, for example, participants are considered to have been affected by the coronavirus if they, their spouse, or dependents have been diagnosed with the virus, or in the situation where they have experienced adverse financial consequences. And these consequences can take many forms, whether it's being quarantined, furloughed, laid off, hours reduced, basically situations that would impact their household income. Or the participant experiences adverse financial consequences due to being unable to work or have childcare options. Plan administrators are able to rely on the participant's self-certification that the employee satisfies one or more of these criteria. They do not have to have additional proof. They just need to have the participant's statement that they have been affected in a certain way. And this relief only applies to certain defined contribution plans, such as 401ks, 403bs, and governmental 457 plans. Now, the relief that's offered by the CARES Act takes three different forms. The first is the distribution, an in-service distribution of up to 100% of the participant's vested account balance, or if less is available, up to 100% of their vested account balance. So either the 100,000 or the 100%. These distributions are not subject to mandatory 20% income tax withholding or the 10% mandatory withholding for distributions before age 59 and a half, and they are not treated as eligible rollover distributions, so no 402F notice is required. However, participants may still request voluntary withholding if they would like to. Generally, the distribution is going to be taxed pro rata over a period of 3 years. Again, this default rule helps with the fact that a distribution of $100,000 in 1 year could create a very high tax bill. However, the participant is free to choose otherwise. At the same time as providing financial relief, the CARES Act also allows and encourages participants to build back up their retirement savings. So following the distribution, participants may recontribute all or a portion of their distribution back to the plan or an IRA within 3 years of the distribution. Now, these distributions are only available in 2020, so they must be taken on or after January 1st and before December 31st. And it's important too, when deciding to implement these distributions, plan sponsors should also take a look at and decide which sources from the plan these distributions can be taken, or the order in which these distributions are taken. The second form of relief is that plans may increase the maximum dollar amount of plan loans to an affected participant of up to 100% of the participant's vested account balance, or if less, up to 100% of their vested account balance. So 100,000 or 100%. This represents an increase from Code Section 72P's usual limit of $50,000 or 50% of the balance account. The coronavirus-related loans are only available from March 27th until September 22nd, which was just this Tuesday. One item to note is that plan sponsors would have wanted to take a look too at the maximum number of loans available. So if there were participants who had already taken out the maximum number of loans, possibly increasing this to allow them to benefit from this relief. The third form of relief is also that loan payments may be delayed for affected participants for up to 1 year. So following this delay period, the plan needs to re-amortize the loan, and the loan payments need to be adjusted for interest that accrues during this delay period. Now, the delay applies to loan payments that had been scheduled anytime from March 27th, so the date of the CARES Act enactment, through December 31st of 2020. Now, since there are different ways to administer the 1 year delay, plan administrators will want to discuss this process with the plan's record keeper to determine how the payment delays are going to be administered, how they'll be re-amortized, in order to understand the process. For all three of these types of relief, the plan amendment deadline for implementing this will be for calendar years December 31st of 2022. So the CARES Act also provides a little bit of relief here as well as far as the timing of amendments. Plans can certainly amend prior, but the 2022 is the deadline for calendar year plans. And in July, the IRS provided some welcome guidance in the form of IRS Notice 2020-50, which helps plan sponsors administer these relief options. As plan sponsors understand, when there are changes to distributions and loan processes, there are lots of detailed administrative procedures that take place behind the scenes. And this guidance provides some additional resources and rules that plan sponsors can rely on. Most notably, it expanded the criteria for participants that are affected by the coronavirus. And it includes not only situations where the participant has had reductions in pay or job offers rescinded, or even delayed start dates for new jobs, but it also expanded the categories of people that could be impacted by adverse financial consequences, as we looked at on the previous slide, to include not only the participant, but also their spouse and household members. This guidance also provides confirmation that plan administrators are able to rely on self-certification that the participant has been affected by the virus unless the plan administrator has actual knowledge. Additionally, detailed administrative and tax guidance has been a relief in assisting plan sponsors determine tax treatment of distributions and recontributions, not only for plan sponsors, but also guidance for plan participants. So a lot of the tax treatment is going to depend upon the timing of both. It also creates a safe harbor method for applying the 1 year delay and re-amortizing a participant's loan, which can be helpful when working with record keepers and administering these. And finally, Notice 2020-50 provides some very limited guidance regarding when plans subject to Section 409A can allow service providers or the employee to cancel deferrals if they take a coronavirus distribution. It's very limited, but it is provided in this notice.
So Tim, do you want to talk about the RMD waivers for 2020?
Sure. Another feature of the CARES Act designed to help, participants and IRA holders was suspension of required minimum distributions. We talked about the change from 7.5 to 72 earlier, but what this provision of the CARES Act does is it allowed the suspension of required minimum distributions. And as we recall, the RMDs are the amount of retirement accounts that have to be included in income each year and distributed out. And if you don't do that, there's a 50% penalty tax. What the CARES Act really did was suspend the requirement for that required minimum distribution in 2020. And it's similar, as the slide notes, to the relief that was provided in 2009 during the Great Recession. Employers have taken essentially two approaches here. One would be to default to continue the RMDs with the individual able to elect not to receive it, or flip it around the other way, default to continue RMD, or discontinue RMDs rather, unless the individual is able to elect to receive the distribution. We had some guidance put out in July concerning the RMD waiver for 2020, and notice 2020-51, and the link to that is noted in the slide. The 2020 RMDs are eligible for rollover treatment, so if somebody received an RMD in 2020, they can elect to roll that over as if it was a regular distribution and not a 7.5 distribution. Plans aren't required to offer a direct rollover option. And 402F notice that's normally required wouldn't be required in this case. And you may not withhold the 20% federal income taxes on rollovers for the RMDs in 2020. The guidance also provides a sample amendment and gives a fairly long tail on the amendment adoption, which would have to be completed by the last day of 2022 plan year.
Great. Additional relief was provided under the CARES Act with respect to DB plans. We're here on slide 27. And this provides a little overview of sort of the timing of relief that was provided with respect to single employer plan contributions due in 2020, now due on January 1 of 2021, or because that's a holiday, by at least December 31 of 2020. It also provided relief with respect to AFTAP elections, with the understanding, of course, that some plans may have experienced fluctuations in asset valuations depending on their plan year and so forth. And this would then allow employers to avoid having lump sum and benefit accrual restrictions. This is optional. Employers don't have to take up either pieces of these relief, but both of them are designed to provide relief for the employers with single employer DB plans. The IRS has issued some guidance on this relief as well. Here on slide 28, notice 2020-61, and it provides some guidance in terms of contributions made after Form 5500 filing, for instance. So for instance, let's say an employer was taking up some of this relief and made contributions after the deadline. You have a calendar year plan, and let's say with the extension you're filing maybe by October 15th, and you're making contributions after that. The guidance gives some helpful suggestions on how to address that. The slide says here the PBGC has not yet provided as additional guidance on its part with respect to when those late contributions, would be considered made for purposes of PBGC premiums. That was true when we wrote the slides, not true anymore. Yesterday, the PBGC actually issued some guidance and has provided guidance in terms of those late contributions as well. Suffice it to say, though, I would strongly recommend that you talk to your plan actuary if you're looking to make later contributions to understand the full implications of the impact of those later contributions and the relief that is provided under this guidance. Retirement plan contributions are always tied to a number of things, including deductions, a whole host of other things, and you should chat with your plan actuary before trying to take advantage of any of this relief. And with that in mind, we're now going to switch from going over sort of the legislation to additional guidance that the different agencies have been providing. In some of this is guidance that they've been providing just with sort of their normal rulemaking and other interests in terms of things. And so it continues to be with respect to the coronavirus. So Tim Arends, why don't we turn back to you to give us a little overview here. First, we're going to start with discussing, at least briefly, different guidance the DOL has been issuing with respect to different types of investment issues.
Sure. So the DOL, well, let me step back. One of the things that's come up in a lot of investment committee meetings that I've been participating in over the past couple of years is the notion of using ESG criteria to determine whether or not a plan should be investing in a particular fund or investment. And that's been kicking around a little while, and it's become kind of a hot item. In response to that, the DOL issued some regulations concerning ESG investments. There's a proposed rule that came out that amends regulations would amend regulations under ERISA Section 404A. Mike Bovis is going to be talking about this a little bit more in one of the later sessions, and so I'm not going to get into the details here, but it is something that is kind of coming to the fore.
Okay.
I'm going to move us to the next slide, Tim.
Yep.
Another piece of DOL guidance that's come out in July was proposed investment advice class prohibited transaction exemption. And what this is about is trying to improve investment advice for workers and retirees. This also has been kicking around a while, kind of back and forth. But the proposed exemption in this case allows investment advice fiduciaries, which would be the brokers and other investment advisors, to give retirement plan investment advice using an impartial conduct standard that's consistent with the SEC best interest standard. So I think the idea there is to really try to align the two together. A couple of key takeaways from the proposed PTE. The advice must be in the best interest of investment advisors, which would seem to go without saying. They may charge only a reasonable compensation for that advice, and that obviously is going to be determined kind of on the facts and circumstances, and what is going to be reasonable compensation, and that's going to be a fiduciary issue that fiduciaries will need to grapple with as they deal with this particular advice. And obviously, they may not make materially misleading statements. So, from some aspects, it's fairly straightforward. Another piece of guidance on slide 32, the DOL issued proposed proxy voting regulations, really dealing with fiduciary duties regarding proxy voting and shareholder rights. That came out on September 4th. The link to the proposed regulation is there. Basically requires fiduciaries to participate in proxy voting when the fiduciary makes a prudent determination that the matter would have economic impact on the plan. And then conversely, it prohibits fiduciaries from participating unless the fiduciary prudently determines the matter has an economic impact on the plan. It sets forth a number of permitted practices that fiduciaries can avail themselves of in determining whether to vote the proxy vote or not.
Great. Thank you, Tim. So, Holly, would you like to talk to us about the DOL guidance on electronic disclosure?
Certainly. I would love to speak on this one. So, in long anticipation of new safe harbors, the Department of Labor issued final rules in May, which created a new electronic delivery safe harbor for pension benefit plans. So since 2002, plan sponsors have been relying on the same electronic delivery safe harbor, which allows delivery by email when you have participants that either have a work-related access to computers, and which is an integral part of their role, or to individuals that have provided affirmative consent to the electronic delivery. Since this time, we've seen a lot of developments in technology and people's ability to access electronic communications. And there has been a lot of times that this has been requested by the industry that guidance be issued to reflect these changes and update electronic distribution. So this safe harbor is limited to retirement plans, so pension benefit plans under ERISA, but it creates an alternative safe harbor which allows ERISA required disclosures to be distributed either to individuals by email or by notice. So first things first, to be considered a covered individual that can receive this type of electronic disclosure, the person needs to either have provided their email address or a smartphone number to the plan administrator, or they have to have an assigned employment-related email address. The alternative safe harbor also applies to covered documents, which basically are any type of document and disclosure that are required to be distributed to participants and beneficiaries under Title I of ERISA. So this includes your SMMs and SPDs, SARs, and other types of notices. It's important to note, though, for as expansive as the new safe harbor is, it does not apply to health and welfare plans, nor does it apply to Internal Revenue Code disclosures. And also, just as a note, this doesn't supersede the 2002 safe harbor guidance. It creates an alternative way of satisfying the safe harbor. So moving on to slide 34, there are certain requirements that apply to this new alternative. And in order to take advantage of it, and once covered individuals have been identified, the plan administrator first needs to distribute an initial paper notice. This notice is designed to notify covered individuals that they are going to be receiving these documents electronically unless the individual opts out. It's important to note, and we won't go into detail today, that there are very strict content requirements that apply to this notice. Once the paper notice has been distributed, the plan administrator may use one or both of two delivery methods. First, plan sponsors could use the notice of internet availability. This is typically an email that notifies individuals that covered documents are posted on a website. They're encouraged to use hyperlinks, include instructions, make it very easy for individuals to be able to go to that site and access the documents. To prevent email fatigue, which does happen, consolidated notices of internet availability can be provided for SPDs and certain annual notices. It's not available for one-off notices like a blackout notice, for example. The other delivery method is email delivery, where covered documents are delivered in the body of the emails or in attachments to the emails. With the safe harbor, though, there are some administrative things to note. First off, there are very strict content requirements for all of these different communications that plan sponsors will need to review and ensure in their communications. The second is that this safe harbor relies on procedures and systems that are designed to help plan administrators identify bounce backs, resolve invalid email addresses, determine whether or not the telephone number that has been provided is actually an internet-enabled smartphone number. So a lot of background processes need to be in place. Also, it's important for plan sponsors to consider what happens following severance from employment and possibly include during the offboarding process obtaining the email address or smartphone number for individuals who would like to continue receiving electronic delivery. And as always, making sure that there is a way to track and deliver paper copies for individuals who opt out or for individuals who request one.
Thank you, Holly. And I guess one thing I would just briefly add is Holly had noted on the prior slide, these rules are applicable to retirement plans, which while helpful, only adds a bit to the complexity of electronic disclosure. So you have electronic disclosure rules from the DOL, some that are applicable to retirement and some that are not. You have electronic disclosure rules also from the IRS and electronic disclosure rules from HHS with respect to, say, the HIPAA privacy notice. And it would be great, just as the agencies have gotten together for their tri-agency guidance on the ACA and other things, if the agencies would actually work together for a consistent electronic notice disclosure provision. I think that would be very helpful in terms of all the plan administrators out there who would like to go ahead and adopt more of a uniform approach to electronic disclosure, but that is for another day at this point. Real briefly, going on to slide 35, I just wanted to mention that the IRS has provided an updated tax notice under 402F with respect to changes including the CARES Act. This is something that you can work with your plan vendor on, but these notices are to be provided to participants who are receiving distributions. And in essence, the updated notices address some of the changes we've been talking about today, such as the in-service distributions for qualified birth or adoption, the new MR required minimum distribution age, and so forth that are addressed then in that notice. One of the things that is worth noting is regulatory guidance that the DOL and IRS provided with respect to the coronavirus in terms of relief on certain deadlines. So the DOL and IRS both independently have statutory authority to go ahead and provide relief in the event of a disaster. And the slide provides more details on that. And the agencies have indeed provided such guidance. They issued regulations on May 4th that actually reach back and provide some relief back to March 1 of 2020 for a period from March 1 until 60 days after the announced end of the national emergency with respect to the coronavirus, what is referred to, say, as the outbreak period. And these regulations, in essence, give participants much more time with respect to several things. On slide 37 here, you'll see primarily these things are with respect to health plans in many cases, with respect to HIPAA special enrollment or COBRA or certain reviews. But the last two bullets in particular are bullets to note. So in essence, this suspension of deadline regulations give time, additional time for ERISA claims to be brought. And so let's say that someone brings or sends you in a claim with respect to a retirement plan. You can process that under your plan's claims procedures, but oftentimes there's deadlines in terms of, say, the participant appealing or the participant bringing a claim or other things. And in essence, what the regulations do here is they give the participants more time to bring those claims and to have those claims addressed. You know, it complicates things for plan sponsors. It complicates things for participants. Obviously, the intent here is to try and give those participants time if they need the time to bring those claims. Maybe they've been ill due to the coronavirus or other things. But there's usually those claims often, say, with a quadro relate to somebody else who's waiting on getting the quadro resolved. And so that can be a more complicating factor if there's a dispute with respect to a benefit under a retirement plan. And that's something you should talk to especially if there's a disputed situation, just to make sure that you're clearly explaining the time to bring deadlines and claims. Let's see here. The coronavirus impact we're going to talk about in a minute. We have a question here. I was going to quickly go ahead and address Tim and Holly, and so you can also jump in here. So the question is, if a 401k plan does not provide for coronavirus distributions and a participant is under age 59 and a half and they're eligible for a distribution perhaps because of termination of employment or a rollover, can the person claim it to be a coronavirus distribution on their tax return and avoid the 10% early penalty? And the answer there, and you folks can correct me if I'm mistaken, is yes. In essence, even if a plan doesn't allow for a coronavirus distribution, a participant can go ahead and designate, in essence, a distribution as a coronavirus distribution. Now, they might have to do some extra work there because, of course, when they get the 1099-R, it might not then have the designation that it was exempt from that 10% early withdrawal penalty, but the individual is able to go ahead and take that position, I believe, with respect to distributions. Any other comments, Tim or Holly?
No, none from me. I think there's another question too regarding 403D plans, Tim.
Yes. So we'd also received a question, do the revised eligibility provisions related to part-time employees apply to 403B plans? And so with respect to that question, the provision in the Secure Act that addresses this part-time eligibility specifically amends Section 401k2 of the code, which of course applies to 401k plans. I believe, so we'll have to see. Already with 403b plans, of course, you generally have the universal eligibility rule that in many cases allows individuals in, although there are some exemptions with respect to it. I haven't seen definitive IRS guidance yet in terms of whether or not that might be carried over to a 403b plan. So I think we'll have to wait. The guidance that was in Notice 2020-68 was more focused in terms of the applicability with respect to counting vesting hours and how it would work with respect to counting hours for eligibility service. But given that it was specifically to 401k, it then might be limited to 401k plans. But that might be something that will be clarified as time goes on. One other thing I'll briefly note, this is a follow-up to the question about the coronavirus distribution. It's a question we've also received is with respect to the new parental distribution. So let's say the question would be that a person takes a distribution from a plan, they're eligible to take a distribution. Can they treat that as if they have a newborn or have just adopted a child and it would qualify under the provision, could an individual potentially treat that then as one of those parental distributions of up to $5,000? And based on, again, Notice 2020-68, I think the answer is there is yes again, that's something that the individual could go ahead and claim certain tax treatment on, even if the plan itself does not address such distributions based on the birth of a child or adoption of a child. So with those questions, I'm going to go ahead and take us through back to slide 38 here and talk briefly in the last few minutes about coronavirus impact. So one of the things plan sponsors are going to have to think about this as this year ends and going into next year is what the impact has been with respect to changes they've had to make this year. So we have clients in a variety of situations. We have some clients who have been severely impacted by the coronavirus. Say if they're in the entertainment or travel or other industries, you've probably been severely impacted. You may have had to furlough people or terminate people. You may have had a cutback. We've had other clients who are in the agriculture area where they may have been busier than ever in terms of things. And so there's this wide range of different situations. Some clients have suspended, say, their safe harbor match for the year and have done that. Some clients have reduced their matching contributions. There's lots of changes that have been brought on just because of the economic consequences of coronavirus. Here's a few things we think that employers should be thinking about. So with respect to defined contribution plans in particular, employers, if they have had to terminate or furlough people, would want to think, have we had a partial plan termination? And generally speaking, that would occur if more than 20% of the employees over a period of time have been involuntarily terminated. If there has been a partial plan termination, there's a need to vest those terminated employees who are not vested at the time they were terminated. And that's something to consider and, again, talk to outside advisors on. In addition, many employers, as I know it, have had a employer reduction in terms of matching contributions or other contributions. So if you're thinking of reestablishing them especially, that's one thing to be thinking about for next year and to think about what provisions your plan has in it. It also is something to be thinking about with respect to non-discrimination testing, as we talk about on slide 39. Those who have suspended, especially safe harbor contributions, are more likely to have trouble passing their ADP and ACP tests. So if you have a 401k plan, those testing provisions are something to be thinking about. And you may want to think about what will happen there in terms of refunds to participants and potential forfeitures in some cases of a match potentially. Finally, another thing to be thinking about with defined contribution plans is just a review of the plan investment performance and how they've been performing. One more slide here, just briefly, the considerations we talked about with the DC plan, there's also considerations with respect to defined benefit plans. Basically, you could also have had a potential plan termination with respect to defined benefit plan if you've had some terminations of employment. And the other issue, and this is obviously reflected in some of the CARES Act relief, is plan liabilities and reinvestment rate returns have been impacted. And that obviously is having and will have an impact on contributions and other things with respect to defined benefit plans. with that, I think we are now at our time of 10:05 for the end of the program. I don't see any other further questions. So we want to all thank you very much for your attention to this first overview. There was a lot of information there. We've tried to include links so that you could go ahead and access information on some of these issues, and hopefully that will be helpful for you. As I say, we thank you very much for your attention, and we're going to take about a 10-minute break here before we come back for the next program. Thank you. All righty, we are back here. It is now 10:15, and we're going to get started with our second presentation. Our second presentation is on retirement plan update, litigation update. And with us are two of our ERISA litigation colleagues, Andrew Hawley and Kirsten Schubert. Andrew, Kirsten, please go ahead and let's take it away.
Thank you very much, everyone, for being here. I will have a couple opening comments, and then we will move to the first slide, which will be our update on the Supreme Court. We have, there's a lot going on in ERISA litigation, and it's definitely a hot area. What's happened here is a lot of plaintiffs' attorneys have figured out that there's a lot of money to be made in these kinds of cases, both because there's a lot of money just in retirement plans generally and group health plans generally, but also because the standards, a fiduciary standard, is one that's somewhat plaintiff friendly. And so what's happened is that plaintiffs' attorneys have started to learn the rules. They've started to understand how ERISA plans work, how 401k plans work, how the ERISA prohibited transaction and fiduciary and preemption rules work. And so and you're starting to see plaintiffs' attorneys more and more who had nothing to do with ERISA suddenly get into it. As a result, we're starting to see an ever-increasing amount of ERISA litigation, and there's nothing to suggest that that's going to slow down anytime soon, absent some kind of drastic change in the law. As our colleague Nick Bullard is going to talk about in a little bit, COVID has only accelerated those trends. As we've started to see more claims, we started to saw some investment losses, which naturally leads to other lawsuits. So it's an exciting time in ERISA litigation, if that's the kind of thing you find exciting. Given the time we have here, we can only hit on some of the high points. But of course, if anyone's interested, we're always happy to talk further about it. So the first thing we have to talk about is the Supreme Court update. And again, the Supreme Court has been extremely active in ERISA. I would bet, I'm not sure about this, but I would bet that if you measure the length of ERISA in terms of the overall US code, I would bet more energy is devoted per page to ERISA than any other statute. I could be wrong about that, but certainly it's a lot. I've seen Supreme Court justices talk on a few different occasions, and almost uniformly they mention ERISA and say how much they hate dealing with ERISA. Which gives you some sense of their view of it. But I think the reason is number one, because the consequences are so great, because the ERISA litigation is because there's so much money going on. And second of all, ERISA is very technical, which means that the decisions are, there's a lot of divergence in the law, and the law is a very important thing in dealing with ERISA litigation. So the Supreme Court has decided a number of cases in ERISA cases in the last year or so, and they have a number more cases on the docket for next semester, in the next term, including in the group health area, particularly including a key preemption case. The first case we'll talk about is the DOL case, and this has probably gotten the most energy. And Dorsey, we here at Dorsey had the privilege to represent U.S. Bank in the litigation and before the Supreme Court, along with some help from a Supreme Court practitioner. The key focus here was less on ERISA and more on constitutional standing. And as you may recall from law school, in order to raise a case in federal court, the plaintiff has to have standing, which, to make things simple, means that they have to have some skin in the game. And in the U.S. Bank case, in the DOL case, there was a case raised by a group of participants, a putative class action against the U.S. Bank and its various officers and directors, alleging that its defined benefit pension plan had been mismanaged. Well, the thing about it was, although there was an allegation that the plan had lost money, during the case it became clear, at least the record was, that there was no risk to the individual participants' benefits. There may have been a loss. If there had been a loss, that loss was something that U.S. Bank had more than enough money to pay for, and it had a statutory obligation to continue to fund the plan. So the question before the Supreme Court was, do these people have the right to sue under ERISA, given that they've suffered no injury thus far and that there's no evidence in the record of a risk of loss in the future? And the Supreme Court held that no, they don't. They don't have skin in the game, sufficient skin in the game to have Article 3 standing, meaning they don't have an actual injury. This was a huge disappointment to the plaintiffs' bar, who had been pushing to allow participants to sue even in the absence of injury. A series of esoteric sort of theories were raised suggesting that plaintiffs should have an automatic right to sue because of basically drawing from 19th century trust law and all these other sort of rules. But the Supreme Court came up with what it would characterize as a very practical rule, saying, you have to have either some actual injury in the terms of reduced pension benefits or some potential risk of loss in the future. What's left unclear from the Thole decision is what the risk of loss is. What do you have to show to say, hey, you know what, a bunch of money was lost, and because of that, I might have not lost any money yet, but there's a risk in the future that my pension benefits are going to be cut back. That decision is unclear. That conclusion is unclear, and we'll wait for another day. But overall, a huge disappointment for plaintiffs. Had this case gone the other way, we almost certainly would have seen another way to define benefit cases. Whether or not we will in the future is unclear, but certainly it's going to be a lot less than what would have otherwise been. The Intel Corp case was a fairly straightforward case having to do with ERISA's statute of limitations. ERISA has a 3-year statute of limitations if the plaintiff has actual knowledge of a breach of fiduciary duty. The court held actual knowledge means just that, actual knowledge. You can't infer it simply because documents were given to a plaintiff from which they could have figured out that there was a problem. That's not what actual knowledge means. So this resolved a circuit split, but it wasn't a terribly surprising decision, I would say. And then we're going to talk about the Jander decision a little bit later. Kirsten will be talking about that. The key to Jander is that this is a company stock case, meaning that the plan, the 401k plan in question, invested in the securities issued by the employer. And again, the courts have been struggling for a very, very long time to figure out when a plaintiff is allowed to go forward in a case, what that they have to allege and what they have to fight, what they have to allege in a complaint to get into the discovery arena. So we'll talk about that a little later. And I will just say, in terms of what's next, two things are particularly interesting. Number one, we're going to have a big preemption case next. We're going to have a big preemption case next term, which is in the health area, but we'll define ERISA's preemption clause quite a bit, I believe. And number two, as we go as a transfer to the next slide, we are seeing a brewing question about the standards applicable to so-called 401k lawsuits. Oh, not next slide. We'll talk about that in another slide. Next, we have arbitration, which Kirsten will be happy to talk about.
Hi, good morning, everyone. I'm Kirsten Schubert. I am a partner in our trial group in the Minneapolis office. I work primarily in the securities and financial services field, as well as quite a bit in the healthcare industry and practice area. I'm going to talk about arbitrations, which I think, unlike some other litigation questions, might be sort of more applicable on a daily basis to people who practice in the benefits field, because it does have to do with how you structure your plan and what terms to include. We often get the question of whether it's permissible and alternatively whether it's wise to include a class action waiver favoring arbitration in your plan documents. As with so many things in the law, especially in litigation, the answer to that is maybe and maybe not. In general, the trend at the Supreme Court has been to favor arbitration. Generally, ERISA favors it as well, but class actions are a completely different animal. So the first question really is whether a class action waiver is enforceable. And at least in the Ninth Circuit, the answer to that is yes, assuming you have the right language. In the Dorman v. Charles Schwab case, a 401k participant brought a class action against Schwab, and its investment committee for breach of fiduciary duty, alleging that his investment in the 401k plan underperformed. The Ninth Circuit overturned its precedent and the ruling from the district court and held that the plaintiff and each plaintiff class member would have to arbitrate his claims as individual matters in an arbitration tribunal. This is a pretty big blow to plaintiffs who often use these class actions as a tool to, get to a larger settlement, potentially larger fees on their end. On the other hand, in the Monroe case, out also in the Ninth Circuit, the court held that an arbitration provision did not extend to the plan for reasons I won't get into here. And I think the overall ticket here is really that it's not completely clear whether you can have a class action waiver and an arbitration provision, but it's definitely a developing area of law and something to look at as you're thinking about structuring your plan. I think the second question here is it wise? And I think the answer to that is also maybe, maybe not, depending on your goals. In the Cooper v. Ruane, Cuniff, and Goldfarb, a participant in the DST system's profit sharing account brought a class action for breach of fiduciary duty against the company and the investment manager, Ruane. The associate handbook that the plaintiff had received as an employee at DST had an arbitration provision covering all legal claims arising out of or relating to his employment. Cooper could elect out of that provision within 30 days, but did not do so. In what sort of is a procedural oddity somewhat, Cooper voluntarily dismissed the claims against the company, leaving only Ruane in the defendant's seat. Even though the waiver was in the plaintiff's contract with the company and not with Ruane, the Southern District of New York granted defendant's motion to compel arbitration. I think potentially to Ruane's chagrin, the plaintiffs then started filing arbitration actions, and defendant has now moved to stay over 400 or so of those arbitration claims. So a little bit of a downside demonstrated there. I think when companies are considering whether to use a class action waiver and force arbitration, you should really keep in mind some of the pros of arbitration and also some of the drawbacks. In general, arbitration is seen as less expensive, cost-effective way, and that could be the answer. But you could also be opening yourself up to some unexpected consequences. For instance, the idea of getting serial filings. You would have to defend each, you would do discovery in each, you would put up witnesses in each, have separate hearings, etc. So it could be sort of an day-to-day pain for you in the business setting. Arbitrators are often less sophisticated than federal judges, and arbitrations on the same claims can have differing outcomes with no consequence. So where you could win dismissal of all claims at the district court in one decision, or even settle all claims in one larger settlement, the individual claim decisions can be much different and much more difficult to predict. There's also no appellate review. And finally, I think something that we deal with a lot in discovery in district court, the arbitrators oftentimes use a split the baby approach, where they want to give something to each side of the V. So that's also something to keep in mind. So we're always looking at the arbitrations, and that is a continuing area of development in the law. Andy? Oh wait, excuse me, I think next. Yeah, so next is the defined contribution litigation. This obviously is cases where participants challenge the offerings in the 401k plans either as underperforming, overpriced, and sometimes because they are proprietary funds. And this litigation continues. The plaintiff's bar had a good year in defined contribution cases. There was over $200 million in settlement, $71 million in requested attorney's fees. And for one case alone, the Tussey case, there was a $55 million judgment, $18 million in fees to the plaintiff's attorneys, not to mention the fees to the defense lawyers, which obviously were not disclosed. So this is a pretty big moneymaker for class action plaintiff attorneys. And But the proprietary investment cases are also still rolling. That's the one we're going to hit first. There is no doubt that you can offer your own funds in your plans. From a practical matter, though, you need to be prepared to defend that decision in litigation. The standard for defending that decision and when plaintiffs can get through on a motion to dismiss and get discovery into really the workings of the investment committee and the background on how you're making your decisions, on how fiduciaries are kind of working in that area, that standard is being litigated right now. Under Putnam Investments v. Brotherston out in the First Circuit, the court found that the defendants bear the burden of proving that their fiduciary breach did not cause loss to the plan. That is, instead of forcing the plaintiffs to prove the fiduciary breach did cause losses. There's a circuit split on that issue, and the Supreme Court denied cert in Putnam, but this is certainly an important question when it comes down to thinking about the extent of your thought processes and the benefits committee's internal working when thinking about whether to offer your own branded funds in your plan. Under Miners v. Wells Fargo, which I also handled here at Dorsey with part of our ERISA litigation team, the Eighth Circuit decided this case a couple of years ago and found that the plaintiffs have to identify a meaningful benchmark to show that the defendant's funds were imprudent. So, looking back from the time that the plaintiffs filed the litigation, instead of looking back and saying, okay, well, defendant investment committee, you should have looked at this one fund that it turns out was less expensive. And ultimately, 4 years later, we can now determine that it performed better. The district court here in the District of Minnesota found that you can't just use a single fund. The fiduciaries have to be able to do their job forward-looking than backward-looking, and the plaintiffs have to come up with something a little bit better than a single fund. The Putnam court touched on this issue as well, finding there, though, that an index fund can be used as the benchmark. Andy, do you want to take the next slide, or if you have anything to add on that, that would be great.
We will go to the next slide. I'll just have a little spin on the proprietary fund cases and the cases generally. The struggle in these cases is always for the courts is always to try to figure out what the plaintiffs have to say in their complaint to let the case go forward. Because it's very easy for them to just say, oh, there was a breach of fiduciary duty, but so clearly that by itself is not going to be enough to get you to the next level, right? To just all of a sudden have to spend millions of dollars on fees and all of this kind of thing. And the situation in the proprietary funds case, you have a situation where you have funds where the plan sponsor is at some level benefiting from it. And so the court is trying to figure out, what do we have to say in a complaint? What does a plaintiff have to be able to allege, given that they know nothing about the actual, or very little at least, about the interior workings of the plan fiduciaries? What do they have to be able to allege in a complaint to go forward? And in the case, it was actually a case and a summary judgment. The court found that there was just no evidence that the fiduciaries had ever really reviewed the proprietary funds, and the court held that was enough to allow a case to go to trial. In the Miners case that we here at Dorsey, as Kirsten mentioned, handled, the court held that just because you allege that there's one fund in the world that did better than the fund in the plan, that's not enough. And so we're struggling, courts are struggling to figure out, where that line is. And I think it's very likely that either in the proprietary funds case, and that same issue, going back to it, that same issue we find in the litigation over 401k plans and 403b plans generally, where there's no proprietary funds. It's very challenging to know exactly what you have to prove in order to let the case go forward. And what we're seeing courts, the plaintiffs will always come in and they will say things like, the funds underperformed for a very long period of time. The funds underperformed for a very long period of time. The funds had higher fees than what would be average. And courts are struggling to say, well, is that going to be enough? Is that enough to get into the expensive discovery part? And the courts are still struggling to figure out that exact line. I mentioned this in the Supreme Court review. certainly it's likely, or at least very possible, that the Supreme Court will have to intervene at some point to try to understand and try to provide some coherence to all the individual standards that circuit courts are adopting. In addition to the 401k, 403b litigation, we also see a number of cases on stable value funds. That's a situation where a party offers a stable value fund. They manage a stable value fund, and they have the right to set the crediting rate. That is the rate that essentially the return on the fund. And we've seen lawsuits by participants in plans, but also by plans themselves saying you had too much discretion and too much power over that because you essentially had the ability to unilaterally change what the crediting rate would be, and as a result, that made you an ERISA fiduciary. And we're seeing some divergent cases on that issue. We're seeing a lot of service provider litigation. That's a situation where the plan itself is suing its third-party service providers because they're doing a bad job, or because they're actually benefiting from the inappropriately benefiting from the services they're providing to the plan. As always, the key issue in these cases is always fees. And always, people are always, obviously, if your service providers are trying to make money and not inappropriately, but there's lots of allegations that these service providers are doing so in violation of ERISA's fiduciary and prohibited transaction rules. And the big thing that we're seeing right now in the 401k sort of fee litigation world is, particularly since COVID, and again, our colleague Nick Bullard is going to talk about this in a little bit, we are seeing much smaller plans get sued. Once upon a time, sort of $1 billion in assets was sort of the limit to the lawsuits against 401k plans. Now we are, as more plaintiffs firms are getting interested in this area, and as sort of the low-hanging fruit's already been targeted, the $9-10 billion plans, we're starting to see lawsuits against plans with 100 million in assets, 200 million assets, and so forth, which really just highlights the need for plans to be prepared for this kind of litigation, to make sure that all your plan terms are in place, that you've got proper documentation of issues, and that your fiduciary assurance is in place, and that you've reviewed everything you need to do to make sure that if a lawsuit happens, that you're ready to go. And one of the emerging issues we're also seeing in ERISA is cybersecurity issues and plan data issues. The fundamental question here is, as an ERISA plan, you have, an enormous amount of data, and you have enormous access to plan participants. And the question is that right? Is that a plan asset? And if it is, there's very significant consequences. Time will preclude us from going into all these cases, but essentially one of the issues, two things are really going on. There's an enormous number of thefts of 401k plan assets that are going on. And I apologize, it sounds like I'm going in and out, so apologies for that. But there's an enormous amount of the theft of 401k plan accounts that are going on, and there's lawsuits over whether or not service providers and plan sponsors are sufficiently protecting participants from those situations. And there's also a ton of litigation right now, or at least a number of cases involving claims that plan fiduciaries gave service providers access to participants, essentially allowing them to come in and sell their services to plan participants. And the lawsuit basically alleges, look, the plan fiduciary should not be giving service providers access to this information to these participants for free. They should be negotiating. That's a big, valuable asset, and they should be negotiating to determine whether or not and making sure they're getting something in return for that access. And we've seen some divided cases on that point. One of the things we've seen, as we talked about the Thole case involving defined benefit plans, what we've seen a number of cases where participants have alleged that participants who had some sort of alternative benefit, who received alternative benefits, maybe being it an early retirement benefit or some other sort of disability benefit, are alleging that the plan's actuarial tables that determine how much they make per month was not appropriate and has not been updated. Essentially, ERISA requires that if you receive, for example, an early retirement benefit, that it has to be the actuarial equivalent of what you would have received if you had retired at normal retirement date. Well, obviously determining whether or not it's actuarial equivalent requires, a determination of lifespan and as a whole, and all sorts of demographic information that the actuaries have to use to determine what you're going to get at early retirement to see if it's the same as what you would have got at at normal retirement. And what plaintiffs are alleging is that the plans have set this in place. The general allegation, at least, is the plans have set actuarial assumptions in place and never changed them, despite the fact that demographics are changing. It's a novel claim, and we've already seen a number of courts denying motions to dismiss, allowing these claims to go forward. We will have to see what this looks like going forward. If we, at some point, we may well get a decision, a more formal decision from a court saying that this theory works and that they're finding, the monetary judgment against a plan. If that does happen at some point, and I'm not saying it will, but if it does happen, we would expect to see more of these, because I think there's a lot of plaintiffs that are kind of waiting on the wings to see whether or not this theory states a case, states a claim. The other thing we're saying is, as we mentioned, the Thole case previously, one of the things that what we're starting to see is the defined benefit plans themselves suing where participants don't have the right to. And the big question post-Thole is are the plaintiffs going to at all try to allege breaches of fiduciary duties and then try to allege that the participants have standing because there's a risk for their benefits? Tim? Kirsten?
Yeah. Tim, could you, oh, here it is, sorry. So I'm going to talk just a little bit about the ERISA stock drop cases. Excuse me, I did not see that the slide had been advanced. Just a couple years ago, these claims seemed destined for extinction. These are claims that arise when the employee benefit plan is invested in company stock. The company makes a disclosure to the market that causes the stock price for the company to fall precipitously. And then the plan participant sues on behalf of the plan in a class for the losses that he or she incurred as a result of the drop in stock price. Like I said, based on this pleading standard that the Supreme Court announced in the Dudenhofer case, these cases seemed like they were going to fade out. But the Second Circuit decision in a case, the Jander v. IBM case, where the court looked at what insiders were required to disclose to plan beneficiaries, changed this calculus. These cases, by their nature, are extraordinarily complicated because the plan fiduciaries are often executives of the company with inside information who are at the same time obligated to comply with securities laws in deciding what information to disclose at what time, but they must also act in the best interest of the plan as a fiduciary, and those two obligations could, in some instances, conceivably diverge, and the plaintiffs claim that they often do. In the Jander case, the plaintiffs alleged that plan fiduciaries should have stopped purchasing stock in the plan based on inside information they obtained through their executive positions about the performance of one of IBM's businesses. The Southern District of New York found for the defendants and dismissed the case, as many other courts have done. The Second Circuit, however, reversed and allowed the plaintiffs' claims to go forward. And the Supreme Court picked up the case, heard it, but remanded without a final resolution. So the fight in the Second Circuit continues on this issue. There was some fear that the uncertainty coming out of the Second Circuit in the Jander case would change the landscape for current cases in this realm. But courts have continued deciding other stock drop cases since the Jander decision was announced by the Supreme Court. The Eighth Circuit, for instance, just came out with an opinion in the Allen v. Wells Fargo case. The Eighth Circuit applied the same standard that governed Jander, the Dudenhofer standard, but dismissed the claims brought by participants who alleged losses to their 401k plans when Wells Fargo disclosed its sales practice violations a couple of years ago. So the Eighth Circuit has spoken on that. We think that Jander is going to keep moving, and the fate of these kinds of claims remains up in the air. Andrew, I don't know if you have anything you want to comment on that particular issue, or on the Vigent Meeks case.
I'll just say very quickly on, courts have been struggling to figure out what to do with these sort of company stock claims in the public arena since literally for 20 years. It's a really difficult thing because ERISA allows you to have undiversified holdings of company stock. And there's an intersection between that diversification exemption or allowance and the securities laws. And courts have just really struggled to figure that out. Everybody, as Kirsten mentioned, everybody thought that they were dead. But now the Jander case perhaps gives a sliver of light. The issues, the Jander decision itself was a bit of a punt by the Supreme Court, saying we're not going to decide these issues yet. Unless the Second Circuit, sort of changes its mind on the standard it has, it's likely that we're going to see those issues go to the Supreme Court once again. And so those public company stock cases might live another day. In terms of private ESOP litigation, however, has been a cottage industry for certain plaintiffs' firms, and we're seeing quite a bit of it. You don't have the same issues there with respect to the securities laws and the overlay between the intersection between the securities laws and ERISA. The Vision case is a case that we handled successfully before the 8th Circuit this year, but you're seeing that case we were able to get rid of on a motion to dismiss, but you're seeing a number of cases, and you're seeing really just one or two plaintiffs' firms that are expert in ESOP issues and have really been trolling the country looking for ESOPs with issues. And having been done so successfully, at least in terms of the settlements or judgments they've received. So we would expect that private ESOP litigation would continue unabated.
All righty. Well, thank you, Kirsten. Thank you, Andrew, for that very helpful update. We very much appreciate it. Our final program this morning is going to actually be a program on a fiduciary update. Mike Vovis and Nick Bullard are going to be doing the presentation. Mike, do you want to take it away?
Thank you, Tim. Good morning, everyone. I'm here to talk about some regulatory developments in the area of retirement plans, really on the investment side of things. And then Nick and I will also provide just a general update about considerations for plan fiduciaries, again, in relation to managing plan investments and plan administration during a pandemic. So the first topic that we'd like to address, and Tim Arends alluded to it earlier in the presentation, is that earlier this year, the Department of Labor released some proposed regulations and guidance around ESG investments. And for those who are not initiated, ESG stands for environmental, social, and corporate governance. It is, there is, to some extent, there's not like a great consensus around precisely what it means, but I've tried to kind of break it down into its three core factors, which are environmental issues related to climate change, pollution, and such, social concerns around diversity, human rights, animal welfare, and consumer protection, and then finally corporate governance often delves into things about the board and management structure, executive and employee compensation, pay ratio issues, and things of that nature. I'm oversimplifying it, but I'm just trying to provide general context of what these issues are delving at. Over the years, this concept of trying to invest in a socially responsible way has come up in the context of ERISA-covered retirement plans. And I think it's pretty fair to say that over the years, Democratic administrations have been somewhat more sympathetic to it, and Republican administrations have been less sympathetic or perhaps more skeptical of it. Back around 2015 or so, the Obama administration did issue some guidance around ESG that essentially can be distilled down to this. And Tim, if you want to advance to the next slide, we can. They sort of came up with what we might call a tiebreaker rule. And I like to think of it as more of a all things being equal rule, which is that when you have two similar investments and they essentially have the same risk return characteristics, ESG factors can be a consideration, a perfectly valid consideration to take into account when choosing a given investment product or fund. The new guidance issued in the proposed regulations it doesn't do away with that rule. That's actually a misperception. There is, a lot of criticism of this new proposed regulation saying that well, I agree that it does to a certain extent. It discourages ESG themed funds. I want to explain what I think that means. But it does not eliminate the all things being equal rule. I think what it does is it requires a lot more rigor for plan fiduciaries to actually get down to the decision that in fact all things are equal. And what the proposed regulation in essence says is that investment selection has to be based solely on pecuniary factors, and that you cannot inappropriately sacrifice investment returns in order to, advance sort of maybe social motives. And again, the criticism of the regulation is that this is, this is counter to demand. There's certainly a lot of demand in the investment community for socially responsible investing. And moreover, many advocates of ESG funds say that it is, perfectly acceptable to take into account non-pecuniary factors when making investment decisions, and that it's possible to do that without sacrificing investment returns. And what I'd say is to those who are critical of the proposed regulation is to actually read it carefully. And the one thing I would say is that the guidance does not say that if all things are equal, that you cannot sort of give the nod to an ESG themed fund. But what it is saying is that, well, it's skeptical of using an ESG fund as its own category. And so let me give an illustration, case in point. Let's say your investment advisor comes to you and says, you should consider adding an ESG fund into your plan. There's a lot of demand for it. It's the fashion these days. So we're going to propose for you, we're going to show you a list of different ESG funds. The first thing you should ask yourself is, well, what is it? I mean, we know that it's an ESG fund. In other words, that the investments are in some way steering away from certain things, maybe fossil fuels or blood diamonds or things of that nature. There may also be other, focus on entities that have good ratings around diversity or good corporate governance reviews. So, but then the question is okay, how do we place that fund in our mix? Remember, we all in the ERISA world invest in accordance with modern portfolio theory, which essentially says you don't put all your eggs in one basket. You have a broad array of different funds of different characteristics, different return and risk characteristics. And so it's not enough to say, yes, and now we're adding in an ESG fund into the mix. You have to ask yourself, well, what is it? What is underlying it? And when you peel back the layers, a lot of times you find the ESG fund is really just another large cap fund. And some sort of large cap general fund. And then you ask yourself, well, how do I compare this? And if you're comparing it against other ESG funds, I think you're stepping into a landmine there, because you're ignoring the fact that ESG fund, which is in essence a large cap fund of some kind, you have to look at it and say, well, how does that fund compare to my regular large cap fund? And if it's underperforming that fund, there's an argument that you are sacrificing performance. And the question is have you done enough rigorous analysis to say, well, we've also mitigated risk. There's a reason that, these funds do not invest in companies that engage in fossil fuels, because, there's a perceived that there's going to be less demand. But in reality, have you done that analysis? Has that rigor been undertaken? Or has it just been simply that an advisor said, here's an ESG fund. Everyone is into it these days. Why don't you add one? Like, that's, to me, a recipe for a lawsuit. And we've seen it in the past, right? Not just with respect to ESG funds. It wasn't that long ago there, most people felt like choice is good. Choice is really good in 401k plans. We can add more funds. And what's wrong with that? Well, we've seen there's a lot wrong with that. You have different funds of the same category with different expense ratios, and some are underperforming yet more expensive. And many fiduciaries just rested on their laurels that, well, it's a 404c plan, so I can't be held liable for that. But in truth, we now know, the majority of courts and the Department of Labor are pretty strict in terms of saying that as a responsible fiduciary, you're responsible for managing the portfolio. And it's not, it's really not appropriate to say more is better. You really have to look at each fund and ask yourself, is it prudent? And the same standard has to apply to an ESG fund. And what I'm saying is that I'm questioning, in fact, that there really is such a thing as a standalone ESG fund. And I think if you read the Department of Labor's guidance, it's what it's really saying is that ESG has to be analyzed across all funds. If you're going to apply an ESG investment methodology, you need to look at it as a metric and a factor within any given fund category, whether we're talking small cap funds, mid cap funds, large cap funds, balance funds, or whatever, that ESG is perhaps a relevant factor in each of those, but you need to look at those and ask yourself, okay, how is ESG being applied? And that's where we really get into really having to look at risk return. And the Department of Labor gives some specific examples, like it's perfectly appropriate to say, okay, here's, say, a small cap fund that is, maybe has some sort of label that it's, ESG kosher, and versus another small cap fund that is not. And if the reason that you're giving the nod to the ESG themed fund is because they steer away from hazardous waste and other potential liabilities, that in fact relates to risk, and that is, it's acceptable to sacrifice some returns if you're minimizing risk. And so the DOL is reminding us that that is the analysis that we have to go through if we're going to be sort of doing picking and choosing amongst funds that have ESG characteristics. Another thing to keep in mind about this general topic is that you cannot, how can I put this? You cannot just, pick a fund and leave it in there as your ESG fund. You need to be comparing it across all of your funds and looking at it, very carefully in terms of risk, risk versus reward, et cetera, et cetera. So I think that kind of covers the gamut on ESG and the Department of Labor guidance. Happy to answer any more questions on that if they come up. But Tim, I think we can go to the next slide now. Okay, another set of guidance that came out earlier this year is the Department of Labor issued some interpretive guidance that kind of, I guess, affirmed that the use of private equity investments in defined contributions plans is not per se prohibited. There's been a lot of buzz around this as well. And again, the reaction to it has been somewhat mixed. For those of us that work in the ERISA space, private equity investments have been sort of a long-standing staple of investing in the defined benefit world. And there is, some logic to that just because of the nature of defined benefit plan investing is really more, how can I put it, more long-term. Liquidity tends to be less of an issue there. Not necessarily it doesn't exist, but it just tends to be less of an issue. Now, in theory, and the Department of Labor is affirming this, that there's no absolute prohibition on investing or offering investment choices that have private equity features in them in a defined contribution plan. However, the concern is really around trying to do that while at the same time managing liquidity, namely in the fact that most defined contribution plans tend to be participant directed. And participants do tend from time to time to move in and out of different investments. People are coming and going. People are taking distributions. Investment committees are constantly I say that's a fair statement, constantly making fund changes in their plans. And what is the impact of being invested in private equity investments, which again tend to be a little more sticky than, and how does that impact your ability to meet your fiduciary duties? So that's really the set of issues to think about. So what the Department of Labor has said is just simply affirming that, look, PE investments are permissible, but they're subject to ERISA's fiduciary prudence standards. And there's just some things that you should keep in mind. It's generally been my experience, and I think the Department of Labor affirms this, that private equity investments, if they're going to be utilized in your plan, that they tend to show up in target date funds, and in particular, custom target date funds. And again, it's not like there is anything per se wrong with that. It's just that, as you may know, the characteristic of a target date fund is that it sort of operates on a glide path. And as a person ages, if they're in a whatever target date, retirement date 2040 fund, that fund is continually evolving and its investment mix is changing along the glide path consistent with its mission. And if you are invested in funds that are not liquid, your ability to manage that glide path becomes a little bit tricky. Now, look, I'm probably not the best expert to be explaining mechanically how that's done. I mean, there are probably many ways in which somebody can manage the glide path and still deal with the illiquidity. At least that's what a lot of advocates of private equity investments say. But it is something to keep in mind. And I've seen it actually in operation where we have a particular plan with a particular fund that it makes it an investment decision to change target date funds. And when it does that, it learns, unfortunately, it's, the existing target date funds are invested in various illiquid things. Could be real estate, could be private equity, and it takes time to unwind that. And that slows down the whole process. It limits your ability to timely switch over into a different fund. And it can be cumbersome and it can be difficult, and you have this period of time where you might be stuck in some component of an old target date fund until you're able to wind it down. So it can be a bit unnerving, and so it's important that if you dive into this, that you be very mindful of what the consequences can be. Aside from that, the Department of Labor provides a little bit of guidance on what they suggest as a maximum allocation with respect to private equity. And, that is, I think, just sort of suggestion. I don't know that it's necessarily needs to be adhered to, and it's no more than a fund's allocation should be 15% according to the Department of Labor. This is an area I think we'll continue to look at and explore. Many of our larger clients have already in some way dipped their toe into this. This is likely to encourage them to continue dipping their toe. And I imagine there will be other fund products, maybe even products on the market, as opposed to just custom target date funds that might even start to explore this. So we'll see. More to come on this, but that's the update on private equity investing. And now, finally, getting into specifically challenges for fiduciaries in the wake of a pandemic. What are we seeing? What are things to be considering? I guess what I would say personally is it might be a good time to look at your participant behavior, look at what's happening with deferral rates, look at inflows and outflows of the plan, look at what's happening with loans to guide you in terms of whether or not you might consider changes in your administration. Now, to be clear, some of these things not everything you do in relation to a plan is a fiduciary decision, right? Some things are sponsor business decisions, but still, if deferral rates are changing or there's distributions and withdrawals, and you might consider looking at whether changes are in order to amend the plan to allow certain things or to slow down certain things, and those aren't necessarily fiduciary decisions, but still things to consider in terms of managing plan administration. Check with your service providers. Every service provider business should have a business continuity plan. It might be a good time to look at the procedures that your service providers have in place in case of worsening of a pandemic. Now would be a good time to maybe have a conversation with them about how they have contingency arrangements in place in case there are just certain things that come up. Again, sort of a run on the bank, massive requests for distributions or things of that nature. And then I guess I kind of touched on this before in the private equity discussion. Evaluate funds with illiquid investment features. Definitely would be a concern if there are going to be significant outflows from the plan. Something you would want to be mindful of. Other sort of things like stable value funds that may have rules and restrictions in place on outflows. And then finally, if there's any significant changes in like service providers that might trigger a blackout, be mindful of that as you're operating in a period of market volatility. People may be going out of the market at a particular point in time. Maybe where the market is down, and then coming back in at another point in time. Again, not to say this is not a reason not to make changes or whatever, but just think about how participants might be impacted if, for example, you were about to head into a blackout, an extended blackout period. So I think that is the end of my comments on challenges in the wake of a pandemic. I think now I'd like to turn it over to Nick.
Thanks, Mike. Tim, if we could actually flip back to that last slide for a minute. As Mike mentioned, my name's Nick Bullard. I'm an associate in Dorsey's Minneapolis trial group, and I specialize in ERISA litigation. I wanted to just quickly offer my sort of litigator's take on this last slide. I can imagine plan fiduciaries feeling a lot of pressure in times of market volatility like this pandemic, pressure to time the market, pressure to pick the perfect fund, pressure to reassure participants. And I just want to stress that it's important to keep in mind that, if this ultimately leads to litigation, if these decisions lead to litigation, courts are not going to punish plan fiduciaries for not picking the best fund or for not perfectly timing the market. The thing that the courts are going to focus on is process. What process did the fiduciary follow? Were the regular meetings held? Were all the funds reviewed? Were the relevant factors considered? The ultimate outcome of those decisions in some ways is less important than the fact that a prudent decision-making process was followed. Process is paramount in these situations. So from a litigator's perspective, following a good process can by itself, get you out of fiduciary breach litigation. And on the flip side, a deficient process could land you in hot water. So I just wanted to quickly give you my sort of litigator's take on that slide. With that, and dovetailing off that, I want to give you a quick update on how the pandemic is already affecting ERISA litigation in the retirement plan context. As my colleague Andrew Hawley suggested earlier, we are seeing a just monumental, huge surge in class action lawsuits alleging mismanagement in 401k plans and 403b plans. We're on track for 5 times more of those class actions being filed in 2020 than there were in 2019. And to make that concrete, through the first 8 months of 2020, we had 65 class action lawsuits filed of that type, compared to 20 in all of 2019. And I can just tell you anecdotally that I personally know that there have been a whole bunch more of those class actions filed in September. So all signs point to this being a record year in terms of class action litigation in the retirement plan context. Now, those lawsuits don't on their face involve COVID, right? They don't, what they involve typically are plan participants claiming the funds in our plan are too expensive, the fees are too high, the funds underperformed their benchmark, things like that. But I assure you that COVID is lurking there in the background. And so that's why I'm saying this is the indirect effect of the pandemic. As we know, in times of market volatility, plan participants are understandably far more concerned and worried about their investments, and they understandably ask more questions about their investments. Now, that anxiety is creating a bonanza for plaintiffs' attorneys. According to a recent Bloomberg Law report, plaintiffs' attorneys are receiving 10 times more inquiries from retirement plan participants over the last several months about the investments in their plans. I don't think it will surprise anyone to know that plaintiffs' attorneys are turning those inquiries and those questions into lawsuits. So from my perspective, it's pretty clear that the pandemic is playing a significant role in this surge of litigation, and we expect it will continue for the foreseeable future. Now, the pandemic isn't just having an indirect effect, it's also having a direct effect. Tim, if we could head to the next slide. So first and foremost, we're seeing plaintiffs using the pandemic's market volatility to claim that certain plan investments are just too risky and that plan fiduciaries breach their obligations by including those funds in the plan's lineup. This comes up in a variety of ways, but here's the usual fact pattern. The plaintiffs will target a particular plan investment with higher exposure to equities, and so that investment is subject to the roller coaster of the stock market. And plaintiffs will say that participants who are closer to retirement should have been shielded from those investments that were more heavily invested in equity. And what plaintiffs have done in the recent months is they'll actually point to COVID and point to the market volatility in the wake of COVID as evidence that plan fiduciaries should have shielded retiring participants from those quote unquote high risk investments. That exact allegation has appeared in dozens of cases filed over the last several months, and I expect we'll see more of it. Interestingly, plan sponsors and fiduciaries are also pointing to the pandemic in litigation. So this typically arises when we see several lawsuits where plan participants are just suing over recent losses in plans that have occurred over the last 6 months, and sponsors and fiduciaries are pointing out that those losses are due to the pandemic, and that provides an explanation for why the plan has lost money. In other words, it wasn't mismanagement of the plan, it was a pandemic. And finally, I note that service providers haven't escaped pandemic-related litigation themselves. We're seeing pension plans suing investment managers and similar service providers claiming mismanagement of funds during the pandemic. So service providers are not out of this as well. So in sum, from my perspective, the pandemic has already had and will continue to have a huge impact on retirement plan litigation. And we'll continue to see, we expect we'll continue to see many class actions filed in the wake of COVID and increased emphasis on COVID in those class actions. Unless you have further comments, Tim, I think we can turn it back to you.
I'm good.
Great. Well, Mike and Nick, I will just briefly follow up on something you said and then ask you to comment on this. So it sounds like our advice in general would be to plan sponsors that the best thing you can be doing during the pandemic is probably what we just said even before the pandemic in some ways, is to have regular meetings of reviewing your investments. In other words, if you have either individuals or a committee that reviews your investments, having regular meetings, looking at those investments. Obviously, if you have an outside advisor who helps you review those investments, making sure you're getting guidance from them, looking at your investment policy statement if you have one, and hewing to that investment policy statement to show that you're following a process. Those are all very important things that plan sponsors should continue to do here during this time.
Fair enough.
This is Nick. I agree, and I would just add that documentation is also key, right? Document that you had those meetings, document what factors were considered, and document what decisions were made, so that if this does end up in litigation, you have documentary evidence of that good process.
Absolutely. Okay. Well, Nick and Mike, thank you very much. Of course, it's one of the challenges for entities is to hear that litigation is on the rise and makes this session only that much more appropriate and important. If you do have further questions about either the developments with respect to plan investments or fiduciary litigation, obviously there's several people in addition to Nick, Kirsten and Andrew talked about the risk litigation earlier and some good points there. But thank you, both Mike and Nick, and actually thank you, Kirsten and Andrew, again for your presentation. That now is the end of our program for the day. We really appreciate you coming and attending the annual forum and hope the information was useful for you. So thank you so very much.